So is inflation temporary or is it here to stay? When you're investing in the markets, this is probably one of the hottest topic for the last 12 months, given that the US government has printed a ton of money. So as of August 27th, 2021, this article by Reuters, the federal chair still think that inflation is temporary. And if you're sitting in his shoe, then you'll realize that why it is difficult to determine whether inflation is temporary or not. And that is really because there are multiple factors at bay that are influencing the market. So in this video, we're going to dive deep and figure out what these factors are, how is the story going, and how the story is going to play out for the next 3 to 5 years. Now, when you're investing in the market, it is important to have a long-term view and kind of to understand the general economics of what is about to happen. And if you have a pretty good idea on what is about to happen, then you can kind of adjust your portfolio to respond to that ahead of time. So it's all about being early, recognizing signs before they happen, so then you're prepared for it. So here are the unanswered questions that we'll be going through in this video. So the first one is inflation temporary? So I think that is probably the big question, and by the time you reach the end of the video, hopefully you'll have some sort of answer or a clear idea on whether it is temporary. And I'm going to share my view with you. Second, is inflation going to lead to a higher interest rate? So this is what a lot of economists fear, that there's going to be higher interest rates, which leads to unaffordable mortgage payments, which leads to a housing crisis like 2008. Next question. How come interest rate remains low for 2020 and 2021? Why is inflation not temporary? So I'm going to give you a couple of articles, walk you through different markets around the world to show you why inflation is or is not temporary. And what does that mean for prices in general? And why does the government has very little control over this issue? Because obviously the government is blamed for inflation and the unaffordability of a lot of things in the world. But in my opinion, I think the government actually has very little control. And finally, what does that mean for the stock market? And what does that mean for the next 3 to 5 years? And I think when you're looking at the YouTube space for investing, there's a lot of doomsday talk on, a giant market crash coming, and, people should be holding cash, so on and so forth. So let's look at the facts, look at what's happening in the market, and then we'll go from there. Now, before we start, I just want to celebrate another 3 case success stories where Mike made 100% from Boeing in 5 months, Famsi made 60% from TSN, and 40% from Baba, and 25% from CRM. So that is the bottom left image here. And finally, Mike also made 156% from RTX in 4.6 months. So that is fantastic. Congratulations to you two. Keep up the good work in Investing Accelerator. So inflation is really a topic that we talk a lot about in Investing Accelerator. So I'm going to share my view with you and kind of the conventional wisdom here on the YouTube channel so it clarifies for the novice investor. So first concept is that inflation causes increase in interest rate. So I'm just going to explain the logic here first because it really comes down to supply and demand. So inflation will increase interest rate because obviously if there's inflation, then people want to be compensated more for loaning out money. So then they will want a higher interest rate, which then will make the mortgage payments more unaffordable and then decrease the housing price. So that's kind of the logic of supply and demand when it comes to inflation, interest rate, mortgage payment, and housing. So that is very traditional, simple, one-dimensional thinking. Now this works as long as we are in a free market, meaning there's no government intervention. Now what if the government steps in and lower the interest rate and continuously buy bonds? Now what that really means is that if the bank comes to the government and say, hey, I need $100 billion, then the government will say, I'll lend it to you at a certain interest rate. And what if that interest rate is extremely low? So here is the effective federal funds rate. So it doesn't necessarily mean that's exactly the rate that the banks will get. So a higher interest rate from the Federal Reserve will lead to banks being less willing to borrow money from the Federal Reserve to lend it out to the people. So lowering the interest rates will lead to the banks being more willing to give out mortgages. So that is kind of like the simple one-dimensional view. Now, what if the government continuously keep this amount very low? Well, because the government keeps the interest so low, it's essentially free money, and the government is willing to buy so much bond in the market that it basically just flooded the market with liquidity, which is cash. So if there is this buyer that would just keep buying your bonds, buying your mortgage, taking on that risk, and lending you money, then the banks will say, well, why not? So then the banks will give you that mortgage. They'll give you that auto loan. They'll give you that personal loan as long as they think they can recoup it to a reasonable degree, and hence increase liquidity. Interest rate remains low because the federal government actually sets the interest rate, and there isn't a competitor that can compete with this rate. So technically, this is a monopoly per se, which some economists is going to come to me and say it's not technically correct. But you get the idea. So if you have the government fixing the rate at a certain level, then, well, obviously the rate is not going up. So what is the consequence here? Well, the consequence is that, well, 40% of the US dollars were printed in the last 12 months, and this article is May 2021. So it's this year, a couple months ago. So that leads to a huge increase in the number of, let's say, dollar bills circulating in the economy. So let me give you an example. So imagine there's an economy between me and you. You make iPhones and I buy them at $100. So if there's only $100 in this economy, then obviously the iPhone is priced at $100. But what if someone printed twice the amount of money, which means they printed $100, but you're still selling one iPhone? So meaning that the underlying production did not change, but the amount of money has doubled. Now, of course, well, you're not going to sell your iPhone at $100 anymore. So what are you going to do? You're going to increase the iPhone price to become $200. So that is assuming there's no productivity change in this example. So that means printing more money lead to higher prices. But the real world is much more complicated than that, because for COVID, we actually have a supply chain issue. So in early 2021 or late 2020, the world has basically stopped producing as much due to COVID, lockdowns, or whatever. So then the commodity price has actually surged up. So this article, April 2021, says that commodity price stable lies after early 2021 gains. So they kind of phrase this as a gain, but in reality, there's actually a giant increase in commodity prices. So here is copper's futures. So you can see that before 2020, price is actually relatively stable, and it actually dropped from January to March during this time. And since then, it has only gone up. So when they released this article, May, they are saying that it is starting to stabilize, which is technically true, but copper price has actually increased from 2.5 here, I'm just using an average, to 4.2. So you can see there is quite a drastic increase. Now, what you don't see is the driver for this price is actually twofold. The first one is supply chain issue, which we know about. And the second one is actually printing money. But because you cannot separate these two effects easily, the government will tell you that inflation is temporary. And you can see how difficult it is because there's no way to tell what is really causing the increase, which the answer is actually both. And because commodity prices are so high, China is actually releasing metal stockpiles to try to cool down inflation. And this is June 2021. And I think recently they're releasing another stockpile again. But China is only one of the many countries that use copper or zinc or iron in the world. So we'll see if they're able to stabilize or at least decrease the price back to the previous level. Yeah, so this is more than a 50% increase. Now, the next thing you'll notice is that because of the supply chain issue, there's actually an increase in logistics costs. So shipping container rates actually top 10,000 from Asia to Europe. And the reason is really because China is still closing off its border at the moment because they're trying to achieve something called COVID zero, which means having no cases at all. Whereas North America and Europe, they just accept COVID as the reality, meaning they would just let the number of cases kind of go up. As long as most of the people are vaccinated, the symptoms are not that severe, so they don't kind of overrun the medical systems or whatnot. So it's two different approaches, which makes it very difficult for China to reopen its borders. So there are some very important implications here, which deserves another whole separate video or whatnot. But if you just go to container shipping costs here, and if you look at the last 5 years, okay, it's around 2K. And now it is 10K. That is 5 times higher. So if you're wondering, if you go to a local grocery shop or a furniture shop and you can't find a product you want, it's because the container cost is too high. So what you'll experience is that, well, first, sometimes local production will be cheaper than importing goods. And second, we're going to be experiencing a lot of stockouts. So on a personal note, I'm actually trying to buy an office chair from IKEA for the last 3 to 6 months, and it is continuously stocked out. For those who know IKEA products very well, it's called Launchwell. So you can see why that in the near future, some of your favorite items will be stocked out, and this actually increases the cost of producing goods for businesses, which will in turn pass on to the consumer, which is you and I. So this actually has a lasting impact. And if you look at this, May 27th, I don't think this is reversing anytime soon. In fact, I actually don't think this is reversing until China can open its borders, because it wouldn't go the other way for the shipping container, which makes it expensive. Now, the next market we want to look at is really lumber. Now, when we talk about lumber, the first thing that would come to your mind is probably housing prices. So for this market, it is actually a little bit ahead of its time because in North America, you are able to produce lumber, so you don't have the global supply chain issue. So previously, lumber actually went crazy in terms of prices, and it has actually gone back down. So here you can see after COVID, which is March, it has actually gone up from 500 all the way to 1700 and then back down to 500. So in terms of the lumber crisis, which is one of the key materials for building houses in North America, this is being resolved. Lumber mill, they ramp up their production, address the demand in early spring, and now they're okay now. So they actually need to reduce production because we're back at $500 or whatnot. But what that led to was actually an increase in housing prices, because obviously people think the material cost is higher, and obviously building a house is more than just lumber, and there are probably parts that require import from other countries like China. Like, if you're building a shower, probably some of the items are from China, which then there's an increase in cost. So here you can see US home prices post largest annual gain, and here it is at 15%. So you can imagine the amount of money being printed, the supply, labor shortage, and lumber prices, which led to this increase. So when people are buying more and more expensive homes, which you will probably observe in your neighborhood, and if they want to use this as an investment property, well, what will happen? If I'm buying a home today and my mortgage payment is $2,500, do you think I'm going to rent it out at $1,500? Well, the answer is no. I'm not going to make a loss as a landlord, so I'm going to rent it out at an even higher price where I can make a profit. Now, for rental properties, the margin might be squeezed. Instead of getting 10% per year, I may be getting 5% per year. But nevertheless, if the mortgage payment goes up or the cost of purchasing the property goes up, I'll need to increase rent. And that is exactly what today's Bloomberg article is about. Rents rise in all big US cities for the first time since COVID. And here you can see the major cities, and an average increase for August is around 10% or higher. So here you can see 20 to 10%, and you can look at your own city to see how much it has increased. Surprisingly, San Francisco is actually pretty low, which I assume it would be closer to 10% or whatnot. But this increase is a reflection of higher home prices. So if anyone here can actually fact check and do a correlation analysis between the housing price increase versus the rent increase here, that would be great, but I didn't get to do that. But I'm quite sure looking at all the articles, that's kind of what it is. Now, one more thing you do need to remember is that previously there was an order by the Supreme Court that you cannot evict tenants. So that is about to expire, and Goldman Sachs estimates that 750,000 households could be affected this year unless Congress acts. So they're estimating 2.5 to 3.5 million households are significantly behind on rent, and the total amount owed is 12 billion to 17 billion. So when October hits, which is next month, these people will be evicted within the next couple of months or a year or whatnot, and then the landlords will increase their rent. Now, whether there's any rent control policy within the local states, or they're trying to live in there for a year and then increase the rent, if the cost of housing goes up, then obviously the rent will be increasing, which is what we observed in the previous article. Okay? Now, so far we talked about commodities. We talked about import goods. We talked about housing. We talked about rent. And finally, the labor market. So by now, you have probably seen news articles that talk about millions of jobs posting, businesses can't hire people, there's a labor shortage in the housing market, and here is an article to talk about it. Now, when there is a shortage in the labor market, this has a combination of a couple of factors. First, after COVID, people realized that they might not want to be that money driven anymore, so a lot of people retired. After COVID, the stock market has gone up a lot, which has made a lot of people who invested in the stock market rich, so then they decide to retire as well. And after COVID, people want more work-life balance, they kind of want to work from home, so they don't want to go back to the office. So with these three major factors in place, we actually have a labor shortage. So what happens when a business cannot hire staff, but then there's a lot of demand because we're reopening the economy? Well, this has not happened yet, but wages will be going up. Now, when wages are going up, you're not going to change the wage the next day to lower it back again. This is going to be a very permanent change, because when wages going up, businesses, the margins will be squeezed, which means they make less profit, and that means they will need to increase price to maintain that margin and maintain that profit. So meaning that when the wage increase hits the market, businesses will need to permanently increase prices. And because these things that are increasing, like rent, where you have an agreement of multiple years, wages, where you lock in a specific rate for many years, businesses increasing their prices. Once they increase, they're not necessarily going to decrease it again. These later factors are quite permanent. Now, to support my claim, I tried to look for the monthly salary, over time, but I actually couldn't find it. But talking to my friends, I actually know that the job market is really hot, which is a sign that there's a labor shortage, and people are getting 10K, 20K raises when they switch to a new job. So that means, coming back to the unanswered questions, inflation is not going to be temporary. Now, the interest rate might continue to be low, because obviously if the Feds increase interest rate very quickly, then they can easily crash the market, which has happened before. So the Fed cannot or will not try to crash their own market. And my estimation is that if interest rate increases by around 2%, then I think there will be a market crash. But 2%, it's a long way to go. And every time they increase is 0.25%. So it'll take at least 8 quarters for them to increase by 2%, which is 2 years. And the moment the market starts to crash, the moment people start defaulting, the bank will tell Feds to lower the interest rate again. So then the Feds will have a hard time increasing interest rates. So inflation is happening while the interest rate is very low. And because of the supply chain issue, because of the labor shortage, the economy is reopening, the government actually does not have a lot of control over the housing prices and or the prices of everything else, because it is essentially a free market other than the loan market where the government is trying to flood it with liquidity. So what does that mean for the stock market? When you look at what's happening, the price of the stock market will continue to increase. Now, this is actually very counterintuitive, because you would assume the stock market would crash. In order for the stock market to crash, one of the two things needs to happen. Of course, there's more than two things. I'm just giving you two examples. The first one is there needs to be some sort of fraud, or some part of the system needs to be broken. So, for example, the mortgage payments are so high that people cannot afford it. So this is a sign that I've been looking for, but so far, the government has kind of solved this problem by delaying rent, and people are still able to pay their mortgage. And with salary increase, people will be able to pay their mortgage in the next little meanwhile. Second, there's less liquidity. So far, the interest rate is super low, so anyone can borrow money at a super low rate, and that means there's a ton of liquidity. And because Feds will not try to crash their own market, they actually cannot increase the interest rate that quickly. They cannot come out and tell you, okay, we're increasing the interest rate from 0.25 to 3% tomorrow. That will lead to a market crash immediately, and they know that as well, so they are kind of stuck. And finally, the last question, what does that mean for the next 3 to 5 years? Now, this is a very complicated question because it is actually a long-term projection. if the economy is reopening, traveling between Europe, North America, and other countries in the world are reopening in the next 3 to 5 years, and companies are experiencing even greater growth than before, increase in price, increase in salary, then the stock market would actually continue to go up until the next unexpected black swan event occurs. Now, you wouldn't know when the black swan event will occur. You can only take advantage of them as they become more apparent. So that's why it is important to have a portion of your portfolio invested. That's why it's also important to have a portion of your portfolio in cash in anticipation of the market crash. But as long as you're able to find discounted opportunities, discounted stocks or whatnot, where you can buy at a cheap price, where you know the company is great after doing your fundamental and technical analysis, then you should be fairly protected because there are a couple of key drivers that will continue to push the market higher, which is business growth, people becoming more wealthy through increase in salary, travel reopening, economy reopening, so on and so forth. And also the Fed is still printing money as well. So that's what I'd like to conclude this video with. And it is a very opposite view of what most pump and dump view in the markets where people keep trying to buy S&P 500 puts. I think the probability of successfully guessing the exact turning point of the market is very difficult. So that's why in Investing Accelerator, we have multiple strategies to deal with a market crash. And if you are scared, then just invest a portion of your portfolio in the market and keep a portion in cash. Now, depending on how much you're holding onto, or depending on your comfort and risk tolerance, this percentage will be different among us. But it's good to prepare for a crash that will come maybe 3 to 5 years from now. So not exactly this year, but 3 to 5 years from now, when the bubble grows to an unbearable level and people start defaulting, then I think that's when the next crash will happen. So that's it for this video. And if you have any economic questions or topics you would like me to make videos on, then you can leave a comment below and let me know. I do read every single comment. So yeah, I'll see you in the comment section.